Let's welcome in a very, very special market voice at this point of time. Madhav Dhar now joins us. Sir, what do you make of the markets last 1 month move after demonetisation? Do you think markets are worried about the slowdown that will happen in the near term and ignoring the long-term benefits?
Oh, of course, and they should be worried about the short and medium term. I mean, this is not only a big economic shock, I think it also raises the risk premium of uncertainty in terms of what else might happen. So I think markets are not being spooked or irrational. I think they're rationally down. And in addition, the world environment also, which was very favorable, is changing a little bit. What was a tailwind in terms of oil prices, what was a tailwind in terms of zero interest rates is starting to change. With the Fed hiking, oil has gone from 40 to 60 at a time when India looked very solid. We've, basically, as far as I'm concerned, made an unforced error and a self-inflicted issue that needs to sort of work its way through the economic system, through earnings, and the stock market is going to be the first to react to that, which is what's happened.
Right. In terms of valuations now, a lot of market experts tell us that valuations are now looking attractive after the recent correction, or if you're a long-term investor, you can try to get into the market. But the EPS cuts are uncertain at this point of time, so it's difficult to say what valuations are.
Absolutely. I mean, I think profits as a percentage of the economy were basing out or were at a very low level. So you could have made the case that we're at the low point of both the economic cycle and the profit cycle. But I think what has happened and the early indications of what it means for the economy and therefore profits, I think has to be readjusted into the market, and that's what's happening. So perhaps we are close to a bottom, but it remains to be seen. I mean, my tendency is to buy panics and to take advantage when you think people are overreacting. Frankly, this is one of those unusual times where I agree with the market. I mean, I don't think the market is acting irrationally. It should be down, and it is down. And I think what has happened is both a extremely unexpected and extremely large shock that I don't know. I mean, the best guess is whether it takes 3 months or 9 months to work through the system. It'll be somewhere along those lines, and that's not fully reflected yet. And the long term, I mean, the case is obviously, that this is, I think, India's in a 20-year up cycle, and the long term will be fine. But the long term is made of a series of short terms, and this short term isn't good.
Absolutely. In terms of what's happening in terms of GST, that could also be disruptive. So demonetization plus GST probably from April. So there could be much more disruption than what the street is already predicting. That's also another fear.
Absolutely. I mean, I think in the short term, I mean, the GST is an unambiguously good thing. Okay, so if you step back and say, if you look through the valley and say that 18 months from now, we will have GST implemented, simplified, understood by everybody, and you say that we would have worked through this, the demonetization, and at the other side of the valley is a securitized, digitalized India with less black money, more transparency, and more openness, it's an unambiguously good thing. But that is not a 6-month valley, that's an 18-month valley, and that is destabilizing for people and for the markets. So I'm afraid that it's more uncertainty out there than was necessary at a time where there is global uncertainty in terms of oil prices, in terms of the dollar, and perhaps global trade with the change in politics in America as well. So I think it's a heady combination of both local and global tailwinds turning into local and global headwinds.
Right. The stronger dollar and with that stronger commodity prices again tells you that it's a different sort of an environment. So last time in probably last December or Jan when dollar went up, all the commodities were trading at their 10-year, 20-year low. But this time around, all of them are bouncing back. So that tells you that this sort of a panic is different.
Yes, it is different. I think the earlier cycle was commodity money flowing into a strong currency at a time of a weak economic environment, which means strong dollar, weak currency. This time, the global economy is starting to revive, led by the United States, so it's a stronger environment, and commodities had hit a very low point in terms of marginal pricing. So this time, commodities are reacting to both extremely low prices and a stronger global economy. So it is different this time. In a way, it's healthier, frankly, and India was probably one of the best positioned emerging markets in terms of being in a different stage of its cycle. But as I said, I think we have a large self-inflicted wound in the short term.
Right. What does all of this mean for risky capital? Say if US were to increase rates, which now even the probability has increased, they probably give a slightly hawkish or dovish outlook. What would it all mean for risky capital with commodity prices being where they are?
Well, I don't think commodity prices, frankly, is a big factor. It's a factor in the short term. It's a factor because it's moved from 40 to 60, but these are still very low levels from a global standpoint. And in terms of input prices, I still don't think it's a factor at all. And I'd go as far as saying that I think commodities remain in a structural bear market. So I'm not so worried about that. I mean, I'm worried conceptually and ideologically. I worry whether a 35-year cycle in terms of greater openness of goods, ideas, services, and people that frankly started with Reagan and Thatcher and more importantly Deng Xiaoping in China, whether that whole trend is changing, whether the narrative is changing, and that is what is showing up with Brexit, with the UKIP, with Trump, and perhaps even with Modi. So if that is shifting, that the world is turning inwards in terms of ideas, services, goods, and people, I think that's not good for risk capital. But it remains to be seen. So I'm not quite as pessimistic as to say that's what's happening and something very big has ended. But I have to say, as a natural and relentless optimist, I am more concerned about that than I have been in the past. So therefore, managing yourself locally and doing the best you can is very important amid global uncertainty, and we have not done a good job of that in India.
In terms of the trade, or as an FII, the trade was by emerging markets, where India was one of the top picks, and probably sell a little bit of developed markets. With the things that you just mentioned about global markets changing, you think that trade can change? And we are seeing that with US hitting a new high every day, some of the European markets seeing buying every day, but other emerging markets are not doing well?
Yeah, listen, I think emerging markets is a hazy concept that has long outlived its usefulness. So the factors that drive Brazil or Indonesia or South Africa are frankly the opposite of the factors that drive a country like India or even Mexico. So I think this facile developed versus developing is really not very useful. I mean, South Korea has nothing to do with Zambia. So these are very different constructs. I would say that it's frankly always been a bad idea to say long India, short developed markets. I think when America does well and the dollar rises, I just think that most emerging markets tend to do poorly, especially those who have deficits and have dollar-denominated debt. If you have a synchronized economic boom like we have in 2003 to 2008, that's different. Otherwise, it's always been different. So it's a much better trade to be long India and short Brazil, frankly, and forget about the US, because that's a different construct. But I think what is happening, people have underestimated, as usual, American resilience and American innovation and inventiveness and its ability to adapt to different morphing conditions. And it's also one of the few countries in the world that's a self-sustaining economy. So America has, as usual, been underestimated and continues to do well, both economically, in terms of its, in terms of its overall system, the ability of corporations to extract profits from it, and the strong dollar is getting a lot of money back in. So that combination is putting the markets to new highs. And again, as I was saying, I think the global bust had exposed not only Brazil and Indonesia and South Africa and the other BRICS, but it also had exposed the overexpansion in China. And frankly, India was standing alone as an island of growth in a growth-starved world. And I frankly think that still remains, but we have basically lost at least 6 months, some credibility, and perhaps irreversibly raised the risk premium of investing in India. And that is going to be difficult. I mean, we'll get over it, but it might take 6 months.
So if you could just tell us about the trade of Fed hiking rates, and probably in India, rates are expected to go down. That is creating a lot of worry, especially in the debt markets, what will happen to flows of FIIs. Do you think over a long term, these things don't matter?
No, these things do matter. I think what happens to structural inflation is probably the most important factor in asset pricing anywhere. So if we have to keep rates up artificially because the economy is weak to protect a currency, I think that will hurt the economy. I think the Indian currency has been one of the strongest in the world next to the dollar, especially in emerging markets, because the underlying economics were so strong. And I think we have hurt that a little bit, so the currency is a little more vulnerable than it was, but I'm not that worried about it. I mean, I think the RBI is surprised people by not cutting. I think that's also a reflection on the Fed hike. So I think just it remains to be seen how this plays out. I still, despite the short-term disappointment, I still think the structural environment in India remains actually quite strong. And the structural environment around the world remains very weak, with the exception of the US and one or two countries. So India will still be a great recipient of flows. It's just disappointing that we can't make the most of what the world offers in terms of capital opportunities. And I think we have lost time and lost a little credibility. John Maynard Keynes said the surest way to destabilize a society is to debauch its currency.
Right. In terms of Fed hiking rates, do you think markets have fully factored that in, and it would not come in as a surprise even if the rate hikes were slightly faster because they have prepared the markets over the last 2-3 years?
I think so. I think the markets seem reasonably prepared. Yes, I do think they are prepared, but you never know. You never know. I think the commentary around it's not just the action, it's the commentary around the action that matters. And the commentary will matter, certainly in the short term.
As you said at the start that you would always want to buy into panic, you would always want to buy into situations where outlook is not that great, but there are chances of improvement. In India, it may not be the correct time to buy the Indian markets, but a lot of sectors do give that opportunity. So real estate, probably some of the other sectors which people have just ignored. What are the sectors that you would look at?
Yeah, I think so. I think if you want to be a big risk taker, I think I would look at real estate. I think it was bottoming out. I think this demonetization has perhaps created the last leg down. And I think with some risk capital, I think that whole area is basing. I think whether you like it or not, I think you will have massive infrastructure spending in India over the next 2-3 years. So if you figure out who are the beneficiaries of the infrastructure spend that is to come, I think that's a fantastic area. And frankly, I mean, India is already down about 10% in dollars in the last month at a time the S&P is hitting new highs. So frankly, another 5%, and I think demonetization and the Fed hike will be fully priced in. So I'm not that worried that the market has a huge downside. I'm just disappointed that things were starting to accelerate and things were setting up nicely, and we've lost 6 months and 10% for absolutely no reason. And eventually, just digitalizing India is a fantastic thing, but this is a very heavy and frankly very unnecessary price to pay.
In terms of whenever the recovery happens, do you believe the sectorial component will change? So till the last 6-7 years, it was only about consumption, it was only about pharma, which is doing well. But now you expect, sectors which did not do well, but their balance sheets are healthy, they may tend to see some recovery?
Probably. I mean, I think consumption is a 20-year trend in India. So structurally, I think those areas will continue to do well. But the more cyclical sectors will have, 1 to 2.5 year runs that can be very sharp and lead to great outperformance. So I think, perhaps we are setting up for that consumption will be fine, but you may have things out of favor, including, technology, which is now almost like getting priced as value stocks at a time where the dollar is rising, which tends to be good for these companies. They may do fine. I think real estate may outperform dramatically. I think if there's more bank cleanup, the public sector banks which have started to do well, continue to surprise on the upside. And some of the big consumption names and frankly, some of the big private banks probably underperform from a stock market standpoint. Could easily happen.
Right. Just, talking about the underperforming names first. So private banks and consumption, there the worry would be valuations. The numbers may still be fine, but markets may not be wanting to pay slightly higher.
Exactly. Yes, exactly that. That they're priced for perfection. I mean, when you trade at 4 or 5 times book value in a private sector bank after 10 years of fantastic profits, nothing wrong with it. That's fantastic. That's a great tribute to the system, but it's priced in. At least I think it's priced in. So I would take my chances with public sector banks, despite all their problems, at book value or below book value, and people can argue what the book value is, but I'm fine with it, frankly. I'll make that bet, and I don't mind buying some of these real estate stocks that are down 90% from their highs 7 years ago, and maybe those highs were unrealistic, and maybe we're not right at the low, and obviously they're in a stressed environment and they have high levels of debt, but then nobody said investing is an easy business.
We just spoke to a real estate expert. He tracks, he's one of the consultant of the top real estate companies. He was clearly of the view that, with digitization coming in, with things changing in the real estate sector, a lot of laws getting changed. These companies, if they actually reduce prices by 10 to 20%, the volume surge may be much higher. And now their balance sheets are not as leveraged as 2008. And that's why even a 20% drop in the prices will not hurt their sales and profit much.
I totally agree. So the reason I'm optimistic is that the solution is easy to see. The REIT structures are coming in, all kinds of things happening. Interest rates will eventually come down. Yes, you may have a price issue, but you don't have a volume issue, and you can clear the system. You can clear, and I wish the developers understood that lowering prices is not some absence of manhood. It's just good business. And as and when that happens, so I'm optimistic because I think the stocks are at 10-year lows and there's a solution out there. And there's no question in my mind that housing from a volume standpoint will continue to boom. I mean, you may have overhang of supply, but that supply at a price. So all these changes, as you say, will help accelerate to clear the system. And the environment may not be good for another 2 years, frankly, but stocks tend to bottom out much earlier than people realize. And I think we probably have already seen the bottom of many of these companies.
In terms of real estate, what we discussed about consumer, that they are priced to perfection. So real estate is totally the opposite. So chances of a decline from here on in the sector are very, very low. Most of the companies which have slightly high debt, have not been performing in terms of profitability or sales growth, or have high inventory, are priced as if there is no future tomorrow?
I think so, but pricing in real estate or highly leveraged companies is tricky. So it's very hard to figure out what the valuations are, because traditional PE metrics, when earnings are meaningless, don't really matter. Same thing in public sector banks. You can say it's only 0.6 of book value, but then what really is book value? What's marked to market? What's written off? So valuation, when you don't really have free cash flow, can be difficult. So you have to have a visceral feel. You have to triangulate to what you think is good value, whether it is, market cap to sales, market cap to market share, market cap to trend normalized earnings 3 years out, whatever you do. I mean, I'd say tends to be more of an art and a science. Yeah, so I do think these stocks are cheap. It's very hard to prove, but I think they're cheap. I think public sector banks are largely cheap. I think a bunch of them will go bankrupt and shouldn't exist. But the remaining stronger ones, I think, are undervalued. So, and I think the capital market stocks, there are not that many of them. The mid-sized capital market companies in India are also very attractive. They frankly have ended up doing well, but these are stocks I've liked for some time. And I think the cycle we are going into, which is a more securitized world, a greater flow of money out of land and real estate and gold into financial assets is going to be fantastic for most of these companies for a long time. They've done well and they may correct, but I think that's a structural secular trend that I like a lot.
In terms of PSU banks, what would be one of the key things to watch out is what happens to NPAs. Now, since about last 2 years, every time most of these large cap companies are coming out and saying that NPAs are done with, we're done with majority of the NPA, maybe a little bit is here and there, but you don't get any sense that they are peaking out. But do you think that now with the exercise that RBI did last year, majority of NPA issues are behind and now there may only be positive surprise?
I'm not sure I'd go as far as saying what you just said, but I would say a big part of the uncertainty is behind us, that they've been exposed. A bunch of them have come clean. Whenever it was 6 months ago, Bank of Baroda took a huge unexpected write-off. The stock was up 10%. So that tells you that the market had already priced in the fact that that even what was very objectively bad news turned out to be a positive surprise. And the old saying in markets is that uncertainty is worse than bad news. I think is more true in public sector banks and in real estate than frankly any other sector, because of lack of transparency, because of leverage. And as that clears up, even though NPAs may continue, I think people's expectations will rise that they're being dealt with and they were not as bad as people thought. I mean, let's be clear. If NPAs were fine, these banks would be trading well above book value. But they're not. So people are still skeptical that has come through, that all of it has, all the dirty laundry has been aired. And so that's it gives me comfort that buying these stocks is fine, because they're already discounting bad news that may or may not happen. If it doesn't happen, it's okay. If it happens, it's priced for it. If it doesn't happen, it's a positive surprise. And nothing is better for NPAs, frankly, than a rising economy. So again, this is an unforced error, but if we bottom out in the next month or two and starts growing, that's also very good for NPAs in the system over time.
At the start of PSU, you said that, a couple of them may actually face a lot of issue and some of them who remain will actually emerge as big winners. Now, for our viewers, it may be very difficult to find these names or, try and find out what's happening. So it's best to buy a basket of well-known PSUs. Some of them have history of greater than 15, 20 years of operation, or buy a mutual fund which only invests into PSU banking space. That could be a good idea for our viewers. I
think so. I think very few of your viewers should be taking shots at single stocks, whether they're PSUs or not. And, that's a general view I have, that you should have a diversified approach. You should not take shots at specific things that can bite you, and you should not trade a lot. They may not be very good for brokers and for TV shows, but it's certainly good for your viewers.
Right. Just also let's talk about the IT pack. So as you said that, value is emerging into the IT sector. Growth outlook seems to be very, very, muted for some of these names. But with dollar index going up, their margins will go up and eventually you will see EPS upgrades. That itself will re-rate these names?
I guess that's my point. My point is that you will never see in a reasonably efficient market valuations being reasonable when growth expectations aren't down. So that's a given. You will never have a situation like that, certainly in the modern day, inefficient markets, that the consensus on earnings is very high and the valuation is very low. So, it's a different version of the PSU syndrome. So therefore, you have to make a bet. You have to make a bet whether earnings will accelerate and are there changes in the economic system or international currency configurations that lead to margins increasing. And my view is A, yes, and B, they're reasonably priced, and a combination will lead to above average investment returns. So I don't have a very strong view on that, but that's my bias at this point.
In terms of IT, if you just look at the balance sheet or P&L of any of these companies, great free cash flow generation, great amount of disclosures, history for really a long time. They could be big dividend plays also, say if there is a further 5-10% correction.
Yeah, could be. I mean, it just depends. I mean, historically, tech companies have been around the world sort of very macho about it, understandably. Apple being the best example of not paying a dividend despite gigantic cash flows, because it's an admission that you run out of innovation and run out of reinvestment opportunities. So understandably, tech companies have low dividend yields and are leery, are not sure whether a higher dividend, frankly, is a positive or a negative signal to the market. And I think you have to go company by company to figure that out. It's hard to make a generalized case for the sector.
Right. Digital right now would be very, very small, and some of these names is something that, you would not even be tracking. But do you think digital, after this demonetization within the IT pack, would be important? And maybe in the next 2-3 years, we have a couple of listings as well from the e-commerce space, but that will definitely be a space to invest?
Absolutely. Absolutely. Definitely, absolutely. No question in my mind. I mean, it's hard to figure out exactly who the winners are. There's some very big, obvious names. The odds are they will win. I don't know what price they'll be listed at, whether they'll be good value. That's very hard to figure out. The fact that this is an inevitability, a big inevitability, and will make a big impact on the market, on the economy, of transparency, of efficiency, no question in my mind. And frankly, that's one of the underpinnings of the structural bull case for India, that people talk about this policy or that policy, but just what's happening in terms of digitization of India, starting with the Aadhaar card onwards to bank accounts, Jan Dhan, financial penetration, bank accounts, insurance, digitization, computerized. It is incredible. And in the end, you should not forget that GDP change is nothing except change in workforce time, changes in productivity. And there's no country in the world that has higher combination of change in workforce time, change in productivity. So that is sort of leads to my sort of relentless bullishness of how things will pan out in India, and digitization and the payment system is a very big part of it, and triggered a lot by, and I think I said it 4 or 5 years ago about when the Aadhaar started. I think people will continue to underestimate what Aadhaar and its progeny and its proliferation in various forms will do to this country. It's just going to be absolutely spectacular, earlier, faster, bigger than most people realize.
Right. Just a word on infrastructure or CAPEX, how you would want to play that? You said about PSU banks and real estate. That's probably what you want to play the infrastructure with, or within infrastructure there are a lot of sectors, and if you like anyone where spending can increase.
Yeah, I don't want to get very specific, but yeah, there are some smaller, medium-sized plays that are more directly related, whether it's directly in construction or road works and some other areas. I'm making a big bet. I just think it's inevitable that you have to do it. It's already starting to happen. The number of road contracts that are being given out are huge, but you have to decide whether you want to play it through some of the traditional price curtailed contracts end up not being great investments, but there are other players that will benefit from just the fund flows through that area. And I think that could be very good. You have to pick and choose, and they tend to be more medium-sized, not big, huge, well-known names, but there are a bunch of things out there that I think will benefit.
Right. In terms of markets, market flows, we always speak about FIIs, but this time around in the month of Jan and Feb, we did not see any major outflow. In the month of November, when markets were out, DIIs did not see any major outflow. In fact, they saw record inflows. Is that all healthy signs? Retailers are investing the correct way, and that should be the way to go ahead, which can get stability to the market as well?
Yeah, I think so. I mean, I've never worried about FIIs. I mean, I think this is a great misunderstanding, as if FIIs are a leading indicator to anything. They're a coincident indicator. So when bad stuff happens, people sell. It's as simple as that. So you can't say, I will invest based on what FIIs will do. I mean, that has never made any sense to me. So what is happening is a structural change with domestic investors, both retail and institutional. And to me, a lot of it is a education of how good the financial markets have been over time. And I think the long love affair, I hope, with gold is over. And as you get more transparency, there is greater propensity to buy stocks and bonds rather than real estate and gold. So the two great competing asset classes to financial investments, I think, are either dying of disease or old age, which is gold and real estate. I think those are very healthy signs, because you want the capital into a productive area that feeds and invigorates the economy, like stocks and bonds, as opposed to gold. And there is this myth that India will consume gold no matter what. I don't think so. I think gold has a 15-year bull market, and people buy more. People buy things that are going up. So once that you've had this crack now, so the myth and the aura of that is gone. I mean, yeah, there may be some cultural affinity for it and so on, but as a real store of value, I think that's yesterday's story. And that's very good for financial flows and very good for a stabilizing influence into the Indian financial system and the stock market. And I hope that it spreads to pension funds and insurance products as well, as it's in other countries. And those, they should not simply be in bonds or government bonds, but they should move out of that and creating a broader, more stable, more liquid, more efficient system, and frankly, give greater returns to the retirees and policyholders and pensioners. So, yeah, all of that is starting to happen, and that's very positive long term.
Madhav, thank you so much for taking out time for us. Always saying that buy in panic, but right now is not the time, but a lot of sectors are already trading at panic valuations.